The question is usually asked, where's the best place to keep my money? I've talked to so many people from so many different places, and people say, they keep their money in their savings account. They may have like investments account, they may trade stocks. Some people keep their money under their mattress, a piggy bank. Some people invested in real estate, life insurance. Some people do annuities. Some people like to buy gold. There's so many different things that people do with their money, and people are always like, well, where's the best place to keep it? And so we typically keep our money in 3 different types of accounts in America, and those are what we call our homes of money. It's a fixed account, a variable account, and indexed accounts. Now, if you keep your money in a different type of account, please drop the name below, but usually they fall within those 3 homes of money. And so the fixed account is one that most people are familiar with, because that's just like regular bank accounts and CDs. These fixed accounts are great for everyday money. Of course, everybody gets paid direct deposit, unless you're getting paid out of check and you go on a cashier, but most people getting paid direct deposit. So of course we need those banks. Of course, if we have like 3 to 6 months of bills that are saved up that we just need to boom, keep it in your bank account. But you also have to understand the functionalities of a bank. And so with a bank account, it's pretty safe. You have some of that safety in there, because of course you have the FDIC, the Federal Deposit Insurance Corporation. They insure your money up to $250,000, but just not a penny more per account. And so, when you have situations like the Silicon Valley Bank or the Signature Bank, where essentially they went bankrupt, they no longer had assets to cover the bills and the money in the account, you find yourself in a situation where if you have more than $250,000 in your account, you SOL. There's people that keep millions in their bank accounts, and when you run into a situation where banks go bankrupt, the FDIC covers you up to $250,000, but the rest of that money is gone. And some people are like, well, how is that possible? If you look at any insurance policy that you have, even with your car, they have the $25,000 to $50,000 bodily injury. But if something happens where you injure someone above that $25,000 limit, you have to pay out of pocket. So that's just the way that insurance works. It just so happens that with these type of places, they're covering your money. And so they cover your money to a certain limit. After that, you're responsible for it. And so it makes you think, well, if we're thinking about long term, if you've ever calculated your FIN number and you know how much you need for retirement, so you know how much you have to have saved to supplement your retirement, 10 times out of 10 is going to be more than $250,000. And so that's why when I say we're thinking about bank accounts, they're great for everyday money. But if we're thinking long term, large deposits, larger picture, not the best place to keep your money. And then of course you have the accessibility portion of it. Like, you can access your money in your bank account. Of course, we got Zelle, we got Cash App, we have all these ways to transfer. You can go to the ATM and withdraw your money, but it's just to a certain extent. Because y'all got to think, like, with your bank accounts, literally your money is kind of just like in this mystical, magical world. Like, we open up our banking app and we see $2,000, $5,000, $20, whatever you're seeing in your bank account. But that's not cash. That's not hard cash money. If you ever go to the bank and you say, hey, I need to withdraw $10,000, $20,000, regardless of how much money you have in your account, regardless of how long you had that account open, the bank will tell you need to schedule an appointment to withdraw that money, or we need to take the time out to order that money. They don't usually have your money just on hand to give to you. And so that's why it's like, you have that access where you can transfer, you can withdraw, you can move your money, throughout the money systems. But if you need cash on hand, that accessibility gets a little shaky. You can have $100,000 in your bank account, go ask them for 50. That's only half. I got 100,000, give me my 50. They're going to tell you, oh, we don't have that right now. Take a moment. And you may be like, well, what I'm going to need cash for anyways? I can just get a cashier's check, which is absolutely correct. But at the end of the day, whose money is it? I don't care if I want to go pull 30,000 out just to throw it around. Whose money is it? Why don't I have access to it? And so, that accessibility portion of it is, like I said, it's a little shaky. And then, of course, you just don't have any growth. You have growth. It's just very, 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 very small. Because if you think about most banks, and I want everybody to think about this. If you go to whoever you bank with, whether that be Bank of America, Chase, Wells Fargo, Truist, whoever, if you go into your bank or going into your banking app, look at your account information, look at your savings account, and look at what your interest rate is, that annual interest rate or APY on your account, and see what that number is. So that's the interest that you have, that your money is growing. So according to the FDIC, as of recent, the average interest rate is 0.45%. 0.45%. And so that's pennies on a dollar that you're growing your money in your bank account. And, when you think about how long it takes for your money to double, what you have available with your money, it just takes a little bit more time because you have such a small interest rate. So you might look at your savings account and they may drop a couple pennies, a couple dollars, here and there. That's that interest rate. And with this, it's crazy because it's like, again, we think about long-term investments and growth, and we're only getting a small interest rate on our savings account. And, people will sometimes ask, well, like, where's this coming from? How are they getting us this interest? And why is it so small? It's because of fractional lending. And so basically what banks do is they take your money and they invest it. And when they invest your money, they found a way to make a 5, 10, 15, 20% return. So that's the interest that they're getting on your money. And then they come back and they give you that little bitty piece, that 0.45%. And so that's that fractional lending. So they're taking your money and growing it exponentially and giving you a small piece. And that's how banks make their money. That's how they're able to loan you out money. That's how they're able to, fund the whole operation, by investing it in other things and giving you a small fraction of it. And we'll get into what they're investing their money in, because essentially they invested in life insurance. Look it up. I'll drop the link. You can look it up. The assets that banks hold in life insurance. It's crazy. It's in the billions. And then they give you a little fraction. And so, you really just don't see a whole lot of growth. Like if you continue to put your money in your savings account and you're waiting for it to grow, you're going to be waiting forever. You're going to be waiting forever. Because if I think about even like my bank gives me 0.35%. And so we talked a little bit about the rule of 72. It's just an equation that Albert Einstein came up with, and it tells you how long it'll take for your money to double based on your interest rate. And so what you do is you take 72 and you divide it by whatever your interest rate is. So again, look at what your interest rate is with your bank. Take 72, divide it by that interest rate, and it's going to tell you how many years it'll take for your money to double. And so if you're thinking about that interest rate, 0.35, you take 72 divided by 0.35. You get 205. 205 years to double my money. Put $100 in there today. In 205 years, I'll have $200. What's going on? Where is this growth? There's not a lot of growth there. So it's like you can save your money in your bank accounts, but you might as well put it in your mattress. Because at least if, you got more than $250,000, your bank going bankrupt, where your money at. But yeah, when people are talking about like what we do with our money, where should we keep our money, bank accounts are great places to keep it, everyday money, direct deposits. But again, when we're thinking about long-term growth, and we have to be more conscious of our money these days, those fixed accounts where the money you put in is the money you take out, there's better options that are available.